Please welcome our next session's moderator, Lucinda Shen, reporter at Axios, joined by panelists Matt Hammer, managing partner at the Venture Department, Rob Haddock, general partner at Dragonfly Capital, Nick Carter, general partner at Castle Island, and Sam Broner, investment partner at A16Z Crypto.
Hi, folks. Thanks for being here in the middle of lunch. I'm Lucinda. I'm a reporter with Axios. I'm here with an all-star group of native crypto investors, Matt Homer of the Venture Department, Rob Haddock of Dragonfly Ventures, Nick Carter of Castle Island, and Sam Bronner of Andreessen Horowitz. So I want to start kind of with the big story of the week, probably, or one of the big stories of the week. It never stops. So Circle, they paused their IPO and then came back. They're now going public at up to a $6.7 billion valuation. I still remember covering Circle when they were going to SPAC, and they were being valued at as high as $9 billion. And the excitement in the room in 2022 was insane. Everyone thought that this was going to be the company that was more potentially, I was hearing from investors, this was more stable than a company like Coinbase. It was the investment. Why has that valuation drop happened? Does it say something about the broader stablecoin economy? Is the excitement around stablecoins a little bit, less than we had previously expected? And I'll start with you, Matt.
Yeah, well, look, I think overall it would be, a great thing for the space. I mean, I know we're going to talk about like the Genius Bill too at some point, but I think any sort of IPO there brings legitimacy to the space and gives a broader set of actors, permission to participate. But I also think like one of the implications going forward of Genius and market trends is that, stablecoin issuance is going to be commoditized in my view. And so I think that for our company like Circle to, be insanely valuable over time, they'll have to evolve beyond just issuance. So I think part of it's probably the market just responding to that dynamic.
Right, like issuance is kind of a fading star at this point?
Well, I mean, the amount of money you make on that depends on the interest rate environment, right? And so to have a business that can really be incredibly valuable over different types of market cycles, you need a model that does more than issuance.
I mean, the good thing about what is happening with stablecoins and the technology that exists from full stack, right, from the blockchain all the way through the issuance, the mint, redeem, it just is collapsing the traditional four-party payments model, right? So you don't actually need to do acquiring and issuance in like separate silos. And that means that the issuance itself should not be by itself that valuable, right? Like Palo has had the best business that has probably ever existed on a per person basis. They've just made so much money from capturing that net interest margin, but that is not sustainable. And Circle understands that, and you look at their S1, and they're sharing 60% of the revenue to Coinbase. They're sharing a bunch of it with Binance. They're over time that, no matter what the net interest or whatever the interest rate environment is, like that is going to trend to zero. And so they understand that they need to be valued like a payments company, and they need to figure out a way to they need to figure out a way to monetize those payments. And so they launched CPN. They are figuring out a way to, maybe we can monetize some BIPs on top of those different flows, but maybe we can do value-added services as well. Like reconciliation is still a problem, compliance is still a problem, and that allows them to get the uplift on the multiple itself, and it also allows them to just have a broader set of capabilities. I expect that pretty much every stablecoin issuer not named Tether is going to take the same playbook. I mean, Bridge went and they came in from a different angle, but now like to use the Bridge full stack, you have to use their stablecoin that they just announced. We're seeing it among some of our portfolio companies who are somewhere in the stack that are doing the entire piece. There is still a transformative technology that exists here, and these are going to, in my mind, dominate the growth of payments over the next 10, 15 years, but it's not going to be issuance alone.
Great.
Yeah, it's a tough time for Circle. I mean, they're completely exposed to interest rates, and I don't know what rates they're going to do, but I think they'll fall at some point. And we're right on the cusp of the largest financial institutions in the world being able to issue their own stablecoins. And it's a distribution game. Like, why did Tether win? Because they had Bitfinex, and all of the early exchanges adopted them. They had the distribution. Circle's distribution is a poison chalice because they rely on Coinbase for distribution, and Coinbase is taking the pound of flesh out of Circle constantly. in my opinion, Circle should just sell themselves to Coinbase.
Yep.
They are, they can't extricate themselves from Coinbase. They're very dependent on them. And then, meanwhile, this bill is going to mean, large financial institutions, probably consortia of banks, are going to be able to issue their own stable coins, and they'll have distribution on day one. So it's a really, really tough spot for Circle, being the more regulated, arguably domestic stablecoin, competing with probably JPM, BofA, Wells, Fidelity, maybe BlackRock, and whereas the offshore game is owned by Tether, totally owned by Tether. Tether's market share, we just published a study this morning, if you care to look on Twitter, it's great. Tether's market share for payments in our sample is 90%. So it's even more than their market share by supply. So really, really tough spot for Circle. We'll see what they can do here.
I think it's interesting that we're like leading a venture panel off with what's going to be the only IPO in the space in like the near term. It's not really where I would want to focus my time, but I think it's an interesting time to build on what Rob was saying and just talk about the market structure here. I don't think that issuance is ultimately going to be what captures a lot of the value. That's really what you were saying, Rob. Like, you probably want to have a coordination layer, or you want to build new applications on top of these stablecoins, or maybe you want to have some of the infrastructure that issuance happens on top of, or other tools. But yeah, I mean, basically, if you're an issuer, you're dependent on NIM, on net interest margin, and there's probably going to be areas where you can either have a more valuable network effect, or offer more new, hard-to-replace value that'll allow you to capture more of the money at work. And so I personally, as we shift towards talking about venture, I'll be more interested in talking about those opportunities.
Yeah, it's interesting. I feel like you ended the sliding scale of like depression that was like happening. So I think this is a good segue, right? Because I think what you're looking at in terms of what's being invested in within stablecoins now is very different from the models of 3, 4, 5 years ago. And so what are you interested in? And then B, also, like, do you think issuing is commoditized? Is it no longer a good wedge, a good starting point?
Can you just repeat the last part of the question? It's hard to hear down here.
Yeah, I'll scoot over. Do you think is issuing no longer, right, it's become commoditized, is it no longer a good starting point? Is it no longer a good wedge?
Yeah, maybe I'll start quickly and feel free to jump in. I think, to get back to the point that we were making earlier about, there is basically a full stack or a full spectrum of what you need to do to be able to have a stablecoin business today, right? And I was talking to somebody earlier, and they're like, okay, we do FX, right? But what their business is some sort of API that it connects to an FX trading desk. And then you have someone that's solving last mile, and they're doing on-ramp, off-ramp. You have somebody who's doing issuance or mint redeem, right? You have somebody who's doing, maybe they're doing some sort of like orchestration versus, or doing kind of some value-added services on top of that into the different regions, right? That entire stack is collapsing. Like, everyone is building in one piece of that wedge right now. The winners in this space will own most of that. And I do not believe that issuance today is where you can find or have leverage to build a new business that is going to go and capture the value across that stack. And so where do you find that leverage? Well, that's something that I think everybody's trying to figure out. Where I'm excited about is, parts of that stack where you own the end customer, you're doing hard things, you're not just wrapping in some APIs into a new API and saying like, here, buy my API instead of somebody else's, and you're figuring out like, what are the needs of your customers? And your customers are, at least in payments, they are very focused on KYC AML. They're very focused on how you can solve their problems in terms of like pre-funding and how it can be more capital efficient. That's how you can get these wedges to then, frankly, eventually probably own that entire stack.
So I will disagree with Rob at some point later today, but for now I'll just sort of build on it again. The way that we've broken down the adoption map so far is to look at broadly 3 categories in the near term and then a 4th in the medium to long term. So the PSPs, the people who are dealing with payments today, they actually see a unique opportunity for margin expansion with stablecoins because they can cut out other players that are in the system. A credit card swipe costs 2.5%. Right now, they're getting just 15 basis points. If we look at what Stripe's doing, they're actually expanding that margin to 150 basis points. And this is the first time, really, they've ever been able to capture that much margin. So it seems likely that in the US and other sort of richer nations, we'll see these payment companies actually being the early adopters of stablecoins. And then we see, and actually your report, the report these guys just published today, points to this. We're seeing international payments be another key use case just because of how bad the correspondent banking system is, how much paperwork it requires, how much time and energy it requires. And then of course there's this huge structural demand for dollars in all the emerging markets where the dollar just has this powerful UX for both small and medium businesses but also individuals. So those are where we're seeing adoption happen in the near term, but in the medium and longer term, there's net new use cases that are sort of uniquely solved by a fast, nearly free, and programmable currency. I think there's going to be disagreement about agentic payments. We can talk about that later. But streaming payments too, things that improve capital efficiency, are also going to be exciting. So those are the 4 areas that we're looking at as sort of the next wedge now that issuance is becoming a little bit more saturated.
Yeah, it's interesting to see a space where the TAMs are exploding. I mean, you probably have around 100 billion, maybe 150 billion of actual payments happening with stablecoins a year. That's just tiny basis points of all the payments that occur, right? And we see how quickly stablecoins are growing. Probably 250 million people worldwide, have used a stablecoin. The supply is up to 240 billion. I mean, like it's up and to the right, but the main benefit is actually the consumer. It's not the corporate value capture at the enterprise level. It's creating an enormous consumer surplus and actually benefiting a lot of the incumbents, the established fintechs. But it's actually a very challenging, value capture story, is my assessment.
Yeah.
I think the issuers are very challenged unless they occupy a very privileged position or they have enormous scale. The orchestrators and the PSPs, there's margin compression, in my opinion. We've seen so many bridge clones, incredibly tough market. The number of bips you can take is coming down and down. The places where we're most excited is the places where payments are not mature, as Sam says. So, we look to emerging markets, places where payments do not work at all, where there is absolutely no connectivity to the broader financial system. So we look at on and off ramps in some of the most challenging frontier markets in the world. We look at these regional exchanges in Southeast Asia, Africa, Latin America. We look at startups that are stitching together connectivity between local banks and stablecoin PSPs. So basically the places where payments don't work at all. Where payments are mature, it's going to be much harder to make money, I think.
So to me, stablecoins feels a little bit like stablecoins are where Plaid was. So I worked at Plaid previously, and in a company they acquired called Quovo, and I remember back in the early days, companies would come and be like, I'm working with Plaid, right? And every company sort of became just a data company, right? And by default, they were using Plaid as part of their build. And I think with stablecoins, sort of every company that touches payments is going to become a stablecoin company, right? And so I think as an investor, it's actually a somewhat difficult time, to invest in this space because it's very crowded, very high founder quality, I think, though, really incredible founders coming into this space. And yeah, every company sort of, could potentially touch stablecoins. I think what I'm interested in are use cases that are uniquely enabled by stablecoins. So what are things that, couldn't exist, without stablecoins?
What's the worst pitch you've gotten on stablecoins, let's say in the past 6 months? Nick is laughing, so clearly he's got something.
We don't keep track of the worst ones, but they don't even make it into the CRM, But what we see a lot of is attempts to just redo what Bridge did.
Yeah.
We see a lot of and these aren't necessarily bad businesses, but it's just very challenging. Stablecoin fintechs where it's just a wrapper on a non-custodial wallet, for instance. We see a lot of that, and I think that's going to be a very, very challenging market because it's what is, how is that sticky? How do you, because if it's a non-custodial wallet, the stablecoins can just frictionlessly move anywhere. There's no stickiness there. So that's a genre of startup we see that's hard.
I think I would just go back to what I said earlier, which is do hard things, right? And to to Nick's point, there's a lot of people, today it is actually very easy to stand up a consumer fintech that is on a non-custodial wallet, that has a card issued by Rain, that is utilizing some sort of on-ramp, off-ramp, or bridge or somebody like that, and you can wrap it and you can go and distribute it. But like, why do you have a right to win when you do that in whatever market relative to new bank that is already there in that market, or name your fintech, right? And people don't realize that consumer fintech is like, it's a knife fight. And people are just like, it is really, it's all a distribution game. It is really, really hard to win. And it's now very easy to stand these things up. I think we've also seen a lot of stuff that's like very, like stablecoins for like affinity groups that are like very verticalized. And like the core piece of this technology is to be more global. It's to get US dollars in the hands of people everywhere. And it's to allow for interactivity, it's allowed for payments, it's allowed for treasury management, for payouts, et cetera, and in all regions of the world. And so like now if it's okay, well, I really want to do it just for this group, for these people, and that's my wedge, especially at a time when your value capture is getting compressed, I think that's just, it's really, really tough in my mind to approach it from that direction. You need to approach it from, I think, a product wedge, not a kind of specific user group wedge. I guess that's not really the worst. I don't know. It's just,
Well, maybe not the worst pitches, but the ones that I'm most frustrated by, I'm pretty vocal about this, are when someone is describing a product that I would consider to be a strategy-backed synthetic dollar. So something where they're building on a basis trade or some other hedge fund-like strategy, and they've turned access to that strategy into the dollar UX. That's, by the way, what I just said, that's an acceptable product, but you probably want to be straightforward about the fact that that offering is not a stablecoin that should be used for payments. And so the only pitch that I really get frustrated by is, because basically people are building productive, useful things very frequently. We're seeing a lot of growth in a lot of categories in stablecoins, is when someone's calling this SBSD category a stablecoin, it's really just not. It's probably not designed for spending or saving. It's designed for investing. And I think just being transparent about that is the only pitch category that I would be, that I've been frustrated by.
Yeah, actually, I want to revise my answer. It's like Athena strategies on like new blockchain with new, like Athena for Algorand, Athena for Avalanche.
but you're bullish Athena.
Oh, of course.
Okay, thank you.
But you don't need to clone it for every long tail asset. That's crazy. Or like Maker for X. Like, stop trying to do it.
I mean, this is a good point generally, which is just that, we see this all the time. It happened all the time in 21 as well. Derivatives, right? So like, if somebody goes and is like a category defined and you're like, oh, well, I'm going to make this like slightly small derivative to some sort of project or protocol, like that is almost never successful. Like you need to be thinking about like, how can I make this thing, a step change better? How can I add some sort of value that is not simply a different blockchain or some sort of like slight derivative to, the way, whatever the like collateral mechanism is or whatever.
Well, on the other hand, just to be totally fair to a lot of the founders that I think are building interesting products, like there's really a lot of, like very few of these markets are decided yet. And so some of them may or may not be, but I wouldn't want to discourage someone and say like, we've reached the final solution on orchestration. I'm just not sure that's true. It may be vertically integrated the way it's being built today. Orchestrators are generally being built fairly vertically, but I could imagine a world where the wallet and the financial account is separate from the money movement and the clearing, and would be excited to see more competition there. But I guess that is also a sort of new take on it, and that would probably not be something that you'd be bothered by.
Yeah, we'll see in like another 2 years, I guess, because I can still remember fintech when neobanks were not popular about 2 years ago, and now they're back again. So it's an interesting cycle. One trend that's been kind of spoken on this panel throughout all of your conversations has been, right, this idea that like emerging markets are really interesting right now. Remittances are really interesting, areas where like there really payments doesn't exist. At what point, what do we need, right? Is there a future where we as consumers here in New York City, where we already have established players like Visa and MasterCard, is there a reality in which you see that us using stablecoin payments on the back end? And it's not Visa and MasterCard that are controlling it, but a stablecoin company or some kind of startup.
In the US.
In the US, yeah.
Well, it will be Visa and MasterCard for a start because they've been working on this for years and years. So they're both, embedding stablecoins into their products. But I think,
right. Or like ones that aren't Visa and MasterCard, right?
yeah, I think like a great value prop for stablecoins, and this is one of the first ones. I don't know about you guys, but we settle a lot of our deals, our new fundraisers in stablecoins.
We do too, yeah.
Especially cross-border, it's instant. You can close on the weekend. You don't have bank wires getting lost for weeks. So outbound payments that are cross-border, especially larger ones, at that point you're just competing with bank wires, and it's not hard to beat bank wires because they're terrible.
Yeah, I mean, I think programmability also is a big part of this. Like, that's what I would expect to be kind of the wedge in the US anyways, is how do we just do things with, like, Sam, I think, mentioned, like, streaming payments earlier. We can talk about agentic payments and, what that means. But there's just, like, more you can do technologically if you use a smart contract than if you use whatever, banking system that from FIS or Fiserv or whoever else, right? I think the modern treasury announcement that kind of replaces FBO accounts with Braille a couple weeks ago was interesting. I don't think it's actually live yet, but I'm interested to see what that looks like. I think you had a point earlier about fintechs. We basically saw post 2008 that we had the unbundling of financial services with fintech for a decade, and then all of them realized that to get any scale, they had to come back together. I think that's kind of what we're seeing here. But to do that, there is a better way to do a lot of those things together, and that is stablecoin rails. Like, you can do savings and payments and trading much easier with atomic settlement on a stablecoin rail than you can do if you're, again, using some sort of like banking service provider.
So this may be a bit of a hot take, I'm not sure, but I think it might be more likely that in the U.S. for domestic use cases, we actually see tokenized deposits before we see stablecoins. I think that there have been efforts at tokenized deposits that failed, frankly, mostly because of kind of regulatory pressure. I think that's absolutely going to come back. I don't see it really competing with stablecoins, though, because I think they're more like internal use cases within banking environments. But I think that may be the first way, actually, that people use tokenized dollars in the U.S. for a U.S. domestic use case.
I mean, the base case of the question, like, when will we see people use stablecoins instead of Visa or MasterCard? For most of the people in this room, you've got like a high-earning credit card where you get a 3% discount and everything. I don't think this demographic is most likely to switch over for buying a coffee in a coffee shop unless there's some sort of vertical specific software that gives you sort of a unique kickback for using stablecoins. So we invested in a company called Blackbird. Blackbird is food loyalty. And if I can go to a coffee shop and with my coffee get a free scone, maybe that's worth it in a way that the 3% cash back I get from my, my Chase card is not. So that might be one reason why I switched. But the biggest one is probably the replacing wires, which we all have like people who sort of handle the wires for us to some extent. It's a horrible experience. The number of times that we send a check and then have to check in on it 3 to 5 days later, and it turns out like some intermediary bank, this is mostly international payments. In the US, it's sort of fine, but some intermediary bank that like may or may not speak the language I want to operate in and is not someone I would want to hire to my team is like looking at a piece of paper to see where the money is extremely frustrating when we could set a payment for less than 1 cent and in less than 1 second on stablecoin rails. So that's the use case that I think will happen first in the US just because it makes such a meaningful difference. But the vertical solutions will happen, that just are going to have separate go-to-market motions. And I don't think it's going to happen quite as globally as we think of credit cards.
Yeah, I mean, that's quite interesting, right? Because I feel like that creates a kind of, this isn't like a worse toppling Visa and MasterCard within the US situation. You guys are seeing like homegrown companies, more so emerging markets, right? Wire payments, large wire B2B payments, things like that. But there is, I mean, what you were saying earlier, right, Sam, you were mentioning Blackbird, the incentive structure. Is there a reality in which, like, and right now, to be fair, stablecoins within the US tend to be a little bit more expensive than existing rails. But is there a reality in which when you guys are talking about Stripe taking more of the overall stack of payments, the fees, that some of that ends up going into incentives for consumers?
Yeah, definitely. I mean, like, that's why having the payment service providers as a key partner is so exciting. they have the opportunity to expand their margin. They're going to want to fight for that, and so they're going to be you're going to be using this expanded margin to give users or other distribution partners an incentive. So like that's all very abstract, but that's really why Visa works so well. Visa pulls in 2.5% of every transaction. They give most of that to the issuing bank, that's like Chase or Citi, whoever you get your card from, and they then use that money they earn to go find you and make sure you have a credit card. And so what we're going to see is that we can compress the margins on credit cards in general. Like, it doesn't need to be 2.5%, but the 1.5% that Stripe is getting, they seem to already be planning with their USDB, that's their stablecoin they're issuing, to give a lot of the yield from that stablecoin to the developers that are integrating it and bringing users on board. And so we are going to see these kickbacks. It's not totally clear from a regulatory perspective how you'll be allowed to give those kickbacks, but we want this to happen. It's not necessarily
be
true
called
that
a
a
kickback.
zero-fee world is the best world. That's right, Matt.
It's a rev
It
share.
probably won't be called a kickback.
Rev share.
Oh, yeah, sorry. Yeah. Matt will have the correct word I should be using instead of kickback.
Well, yeah, let's talk about the regulatory environment for a second, right? We've got a couple of, and I do have a couple of questions about this. So A, we've got a couple of bills out there that are possibly going to be a thing. We've had a couple of delays and setbacks. What's going on? Do you have a preference for which bill goes through? What's going on? I'll start with Matt.
The Genius bill is the one that is in the Senate that has, sort of passed through some procedural milestones on like very bipartisan votes. It's on its way to a vote in the full Senate, right? And then the House will have to pass something that's sort of, somewhat similar. And just, to kind of maybe summarize it just briefly for people who don't kind of follow it every day, but it basically creates a federal standard for what it means to be a payment stablecoin. So it defines the concept of a payment stablecoin. It creates a pathway for getting a federal charter from the OCC to issue a payment stablecoin. Banks will be permitted to issue payment stablecoins. And then you can also get a charter from the states for under $10 billion in issuance. And then the requirements are pretty straightforward, frankly. I don't think that those are controversial. It's one-to-one backing, redemption rights, bankruptcy remoteness, things that are sort of common sense. I think there's been some disagreement around the edges around like BSA AML requirements, consumer protections like Reg E, but I think we will see something. I think that, as I was saying earlier, I think that it will have the effect of, standardizing the space, and sort of commoditizing issuance to some extent. I think that, the institutions that win in that environment are those with scale, trust, and distribution. And so I think we could see new issuers actually, but they're probably not going to be startups, right? They're going to be banks and big kind of established institutions who can do that.
Right.
So I think it will be hugely significant also in terms of just giving. I want to make a point actually. I think stablecoins are already like legal today. You can offer stablecoins in a legally permissible way today, like Circle and others do, right? So, but I think what Genius does is it legitimizes the space and it gives permission to a broader set of actors to participate in the space. I think we're going to see some really interesting stuff actually with even banks and being able to like kind of deposit stablecoins in bank accounts, withdraw in the form of stablecoins.
Yeah, are you guys seeing, right, that's actually an interesting point in that, are you all seeing certain business models that previously would not have been applicable? Because, right, the banks are the big missing piece here, really, that this enables. And so are you seeing business models that are now possible potentially if the stablecoin bill were to be passed, that kind of interaction?
Well, I'll give you one example. One thing I didn't mention is that it would ban yield, which I don't like that, but I understand kind of why that's going to happen, just given the constituencies that are involved. So if stablecoins cannot provide yield, I think one implication.
Well, they would have to be classified as securities, right?
Right.
It doesn't outright ban
Yeah.
them.
But they wouldn't be a payment stablecoin. I think that actually creates a market opening for tokenized treasury funds and tokenized money market funds. I think that we'll see like a blurring between those instruments and being able to like swap instantaneously and atomically between stablecoins and tokenized treasury funds, tokenized money market funds. I think it's possible in the future. You can imagine a scenario where sophisticated institutional users of stablecoins actually only touch stablecoins at the point of transaction, like for that instant, and that's it. And at any other time, they're holding it in tokenized treasury funds. I think that we could see those sort of things emerge as an implication of Genius.
Yeah, I think maybe this kind of goes a step beyond maybe what Stablecon's remit is, but tokenization more broadly, like stablecoins are essentially a tokenized version of a US dollar or treasury. What stablecoins and being on blockchain rails for settlement are going to allow for is something that's very interesting across a bunch of different financial assets. So if we think about like, okay, so tokenized money market funds, we think about like what's happening in collateral mobility right now. I mean, Broadridge is doing basically $1.5 trillion of a repo. It's like $200 million a day of a repo on chain. It's kind of a private blockchain, but eventually, hopefully, that opens up to something that's more public. I think some of what we've seen in terms of recently, Apollo had this private, basically this private credit fund called ACRED, where they were allowing you to essentially lever up ACRED in Morpho on DeFi to go from an 8% net return to like a 19% net return atomically, quickly, and with stablecoins. Those types of transactions, those types of structured products, those types of derivatives, those are going to be uniquely enabled by the fact that we have stablecoins and we have repo and we have money market funds and we have private credit funds all tokenized on blockchain. So for me, if I think about like what am I really excited about going forward, I'm really excited about the payments use case because we've been talking about it a lot, we've invested in that a lot, but I'm excited about essentially just the re-engineering of the financial ecosystem and the financial rails in general. And I think stablecoins are the core piece to what is going to be a change to all of what we're doing in finance.
Yeah, that's well said. Domestically, I think stablecoins will become much more deeply integrated into the core architecture of the financial system. I think it's unfortunate that the bill prohibits yield. That actually eliminates a bunch of business models, and it encourages offshore stablecoin issuance, and it kind of bifurcates the market a little bit. There'll be much more attractive products to hold offshore. Unclear whether a financial institution in the U.S. will be able to hold an offshore issued stablecoin. I think that's still a little bit TBD. But I think that's a shame. That's one of the consequences of the bill, is that it actually makes the product a little bit worse for everyone.
Yeah, I agreed, but I just to go back to what Matt was saying, I probably would look to the different verbs, like what do people actually do with stablecoins? They spend, they send, and they earn. And for spending, you probably want it to be dollar denominated, and it might only take a second. You might not need to earn on the dollars that you're spending. For sending, you could do it in either wrapped treasuries or in dollars, and it's your choice, and you can move out. And for earning, you do want to earn yield. And it may be that the yield conversation's actually a little bit less important than we think, because when you're trying to earn money with something, you might be willing to put it aside. And you're saving at that point. And you're saying, that's the money over here. And we all do that every day. I prefer a world where yield-bearing stablecoins are possible. I'm just not sure it needs to be endogenous yield. Although it'd be great to have more flexibility for entrepreneurs to build cool things. It just isn't the most important point, because I think the user experience is such that you might actually be okay pivoting in and out of these yield-bearing assets.
Do you think midterms will change anything? Did the midterms throw a potential wrench in things?
I don't think they do for stablecoins specifically. I definitely think they do, and I'm sure Nick has views on this as well, for the broader set of kind of legislation that we were hoping to get for crypto. I think the reality is,
structured bill?
Yeah, my perspective is a market structure bill is probably dead at this point. It's what we're hearing from a lot of different people. There's a lot of tailwinds that has come to crypto and to stablecoins because of this administration, but we're not being helped by a Trump meme coin, and we're not being helped by a lot of the business that is being done by World Liberty Financial. And so now in DC, because of that, there has been a desire to kind of organize against some of the bills and some of the kind of legislation and some of the rulemaking that we would have expected otherwise. And a lot of that political willpower is getting spent on Genius, which is great for this crowd and great for, I think, for a a lot of our portfolio companies and us in general, but makes it it probably means that that is going to be spent now and is going to make it really hard to do market structure. It's going to be really hard to do some of the other things that we want. And if midterms flip, that only gets that much harder.
Gotcha. Sorry, clarify for me, because I can't completely hear what you just said. You said Trump. Do you mean his tokens? What he's been doing?
Yeah, the token. Yeah.
Okay. Like you think that the kind of political scrutiny that's been on it, or like the headlines that have been on it, have been or potentially.
I mean, I think it obviously depends on who you ask, right? But
Right.
I think there is a perspective that there is profiting of the office happening, and at least among the Democratic Party and people are organizing around it, they are upset by that, and it has given them a stance and more political will and more ammo to say, hey, listen, we don't want to necessarily push forward the space in a way that they would have otherwise, and I think would have been able to get bills through in a more bipartisan manner before.
Yeah.
Yeah, I mean, it's very strange because from the Democrat perspective, you should actually want the stablecoin regulation. You should want more federal oversight. That's generally the Democratic view. As opposed to right now, it's kind of Wild West. You can still issue a stablecoin and do stuff with it with no oversight. So they should be in favor of a stablecoin bill, but there has been this organized resistance to it because of the apparent, and I would say very real conflicts.
Yep.
World LibertyFi issuing a stablecoin is very unnecessary and was a big political setback and very short-sighted, in my opinion.
Yeah. Because it's kind of interesting because I think there were so many, right at the beginning of the Trump administration, there was so much excitement about his administration, his friendliness towards crypto, but then now his personal interests
He's a
seem
little
to
too
be
excited.
Yeah, a little bit too excited. Seem to be kind of impacting the broader space as well, and it's made it more political. It sounds like.
Yeah, we don't need the president to be a crypto entrepreneur. You can just leave that to us.
I want to talk a little bit also, we're backstage, and the one thing that we haven't really talked about, I think AI has taken a lot of air out of a lot of different industries. It's both helped and hindered, right? AI's helping with operations and everything. It's lowering costs. You need less people, but at the same time, they're taking a lot of smart engineers. B, do you see a blending now of AI and blockchain and crypto companies? And is there a business model there? Or Nick at least has a very strong thought against this.
Look, I actually want to ask this to the rest of the panel, agentic payments, everybody assumes that crypto has to be the currency of the AI. Why can't, the AI models of the future, the agents, why couldn't they use Stripe's API?
Well, everyone is using Stripe's API right now. Yeah.
So why do we need the agentic, solution for the AI to use stablecoin?
Okay, let me give an attempt at answering this.
Okay.
I don't think it's strictly necessary. There's not just one solution to most things, especially with software. It's an open field. But there's a couple things. Visa and MasterCard can't process sub 1 penny transactions today. So that might be a problem. You might want to do things that cost less than 1 penny if an agent's asking for some piece of real-time data or some other thing. Another problem might be that Visa and MasterCard have sort of a structural issue with working with agents because it changes their current market structure. They want to charge 30 cents fixed cost plus 2% in addition, and so there's an onboarding problem. But then the third thing is that you've got a bunch of new services that you might want to add to agentic payments that don't currently exist, and programmable payments are a good place to start. So you might want to link payments to identity in a way that's more cohesive than we have right now with payments. You might want to have insurance or reviews of the quality of agents you're paying in a way that doesn't really exist. You need a new marketplace. These are just the beginning of possibilities, and I'm not an entrepreneur that's building in this space, but we're seeing people start to try, and they're preferring the UX of stablecoin payments over traditional rails because these things can be built composably on a credibly neutral platform.
Yeah, so I don't actually think people are preferring it over stablecoin rails because if you look at where all of the AI agentic payments are happening today, they're all using Stripe's API. Basically, 99.9% market share today, and that's not Bridge, that's Stripe, their typical API. I think there are some things that, or some of the arguments that I think don't make any sense, which is, for instance, on the basically like the know your agent or the identity piece. If you go talk to Visa right now, they'll tell you, listen, we have a tokenized credentialing that you can use basically much easier than you can actually use anything that is on blockchain. It will be used for agentic payments going forward very quickly. And I think a lot of those use cases, and you can use a virtual card, and those virtual cards will have, they'll change the fee structure so you don't actually need to charge 30 cents for every debit swipe. So I think for a lot of those arguments are really tough, right, to justify right now. I do think, and I've talked to a bunch of entrepreneurs about this, and I talked to one recently that actually was getting close to convincing me, and so I'm open, I'm open-minded, and I want to hear from more of you.
Tell me which one that was after that.
Tell us all which one backstage.
But I think there is a lot of reason to be bullish around the programmability of payments, the provisioning of use cases, or like how you may go and spend those stable coins, and then that being much easier to do in some sort of like smart construct relative to a kind of closed loop enterprise workflow system, which is what a lot of what we're seeing today. I don't have enough imagination, but I don't see a world in which like my AI agent is running around without guardrails and like figuring out how to spend for me. I know people are talking about that, but I think there is a world in which it makes sense in very narrow cases, but I don't expect that there is some sort of like agentic economy that exists outside of like what we do today where they're all using stable coins to pay each other. But I don't know, maybe Elon is just much smarter than me, which is actually probably true. So.
I mean, one feature of agentic payments that I imagine may be important in the short term will be reversibility too, where traditional payment rails probably have an advantage.
You would want reversibility.
Yeah, I mean, if my agent's buying stuff for me, I may want, if it goes crazy.
Yeah.
You may,
The other thing that I'm like a tiny amount worried about is malicious AI having the ability to hold funds, totally sovereign, and utilize those funds for its like evil purposes. So I actually think crypto makes, like, once you do see a malicious AI emerge, crypto is going to be the thing it uses.
Okay, great. So, that's good.
We should be prepared for that.
Malicious
but probably
AI.
Not stablecoins.
No, probably just Bitcoin.
Yeah.
It's just malicious AI. As in, I feel like we're having like a sci-fi novel written here, but like malicious AI, like accidental AI, or like agent AI from like North Korea, from a malicious state actor, or both.
Well, just like hypothetical, AI taking over the world.
Okay.
They'll use crypto to do it.
Like this is
But that'll be on our conscience. That'll
yes,
be our fault.
That is true, yes. This kind of brings me to, I'm kind of curious, this was news, Meta is working on, reportedly at least, right? Not confirmed, is reportedly working on stablecoin payments and creator payments again. Something like multiple startups and fintechs, both in crypto and not, have tried to do. What did you think of that announcement? Did you have a reaction?
Every company is going to have a stablecoin in the near term. I think like there's just like people are too excited about this, and so Meta and Google and like all of these tech companies, or 90% of them will probably issue a stablecoin, and then 90% of them, of that 90%, will be like, this was actually a huge mistake, and we shouldn't have done this, and we should have like outsourced it to somebody who knows what they're doing. So I think it's just the inevitability of like the incentives of the system right now. But I would tell you, if there are any executives in the room, don't do it. Use somebody else.
With the caveat that Genius prohibits big tech companies.
For tech specifically.
And so Genius is actually trying to protect these companies from themselves because they don't need to issue, just use someone else's stablecoin. Like one of the big fallacies in stablecoins is that every company needs their own. That's crazy. We don't need like a neo free banking era. With all of you have to do like a credit analysis of every issuer. Like that's crazy. We just need like 2 or 3 stablecoins at most.
What is your guys' expectation for like the steady state of how many stablecoins there will be that are widely accepted in 2 years?
US dollars?
Yeah, how many different US dollar denominated stablecoins?
5?
I was going to say 3 to 5, but then you'll have like a long tail for specialized use cases. I think, but.
I don't think you need that many. There'll be Tether, Circle, and then the BOFO, Wells, JPM consortium stable, and that'll be it.
Yeah. So
I would disagree with that a little bit, because what I do think will happen is like the Paxos model, where they like white label stablecoins for others, and then there's some sort of shared liquidity layer. Like I expect that to be actually pretty popular, and so maybe it won't be whatever, like PYUSD will be in its own for its own use cases and accepted, and then you'll have whatever the next 15 Paxos stablecoins are. I expect we'll see a lot of that, but there'll be some sort of interoperability between all of them.
That's my expectation as well, is that it sort of depends on how the question is phrased, but I wouldn't be surprised if we have something that looks like Visa, MasterCard, and maybe 3 to 5 core trust marks, like brands that are, but then quite a few people who are issuing on top of that group. And maybe that number is like 30 to 50, just because a lot of people want to have some slight customization or preferred access to the benefits of having their own stablecoin.
Okay, great. Well, I'll give you guys one more kind of round robin very quickly because we're almost out of time. When do you think we're going to get the next stablecoin IPO?
After Circle.
After Circle, yeah.
Well, every company is now a stablecoin company, so.
Well, let's say pure play,
3 months
not
later.
like the Meta with a stablecoin like issuing as part of their business, or sorry, not issuing but like wrapped into their business.
I think within 18 months of Circle.
Okay.
I mean, assuming the market continues
Yeah,
to be
that's pretty
good.
positive. Yeah.
I bet we get I don't actually bet this, but I've a presumption, or at least I think it's possible that Tether might try to do like a reverse merger into a public company.
Oh, interesting.
If you count Fireblocks as a stablecoin company, which are not really, they could be next, or maybe Anchorage.
Yes, very on theme.
I think it's going to be whatever the next fintech company is to go public. I mean, stablecoins are just a better way to build those products, and so non-answer answer for you. It'll happen sooner than you think.
Yeah, I think that's cheating because Chime is most definitely not a stablecoin company.
We'll see. Yeah.
Okay. All right. Well, thank you all for joining us today, and thanks for having us.